Well, welcome to our High Rock monthly video, and happy Cinco de Mayo for those of you who care. I am Scott Tomlinson, and with me on the call is my partner and colleague Paul Tepsich. Our certified financial planning professional Bianca Tomlinson is still working on a part-time basis. We all hope that you're doing well, staying healthy, and looking forward to getting and we are certainly looking forward to getting our lives back in some degree, hopefully soon. So April was definitely a better month than March. Oil was likely the biggest story of the month, as it touched levels that we've never seen before. Oil prices on the May futures contract traded at negative levels, as supply concerns were really the story behind it. Traders feared having to take delivery with nowhere to store it. And we joked at the time that if you had a swimming pool, you might be able to take a few free barrels plus maybe $40 to $50 per barrel. The times are pretty crazy. Paul, any comment?
Yeah, and that was a very technical situation, but it was also telling about how much demand destruction has been done certainly throughout the oil markets. But I was actually just reading this morning, they were talking about various large U.S. cities and how much traffic congestion is down, and it's somewhere in the neighborhood of 85–90% versus normal times. So very significant reduction in demand. And oil, as a liquid product, gets refined and turns into gasoline, but roughly only 40% of oil that comes out of the ground is used for transportation, and all forms of transportation, not just driving. So industrial applications, commercial airlines, everything. It's quite stunning. The June contract is obviously trading much better, and the last couple days has been moving higher.
Yeah, I hear it was up about 20% today or so.
Yeah.
Volatility in April was down off the highs as financial markets rebounded. Canadian equities and Canadian preferred shares best performers through the month. U.S. equity not quite as good. Certainly bonds still performed well. Global equity performing well, and last but not least, Canadian REITs. But on a annualized basis, it looks a heck of a lot different, or not an annualized, I'm sorry, from a year-to-date basis. Bonds still above water, but nothing else is. And U.S. equities down 12% over to the end of the month. Canadian equities down, and global equities down close to 15%. Canadian preferred shares down over 17%, and Canadian REITs down 25%. And Paul, a while back, we certainly reduced our exposure to Canadian preferred shares. In fact, I think we've added a little bit more recently, but and Canadian REITs we exited quite some time ago, and that's been great. I know of some advisors out there who perhaps cheated on their balances just a little bit and added or are carrying more preferred and shares and REITs as a result of the distribution income that they're able to garner from that. But we had a colleague a long time ago that told us that the road to hell was paved with positive carry, and that's what that's all about, I guess, right?
Yeah, it certainly has been, yeah. And same with REITs. I mean, they pay a big dividend. So I have two comments on both those security classes. Canadian press, I think I probably have said it before, but they are the most complex cash security in the country. They're extremely difficult to value. We happen to have an Excel macro that helps us value certain preferred shares that we use at least monthly, and that does help us a lot. And Canadian REITs, from a fundamental research perspective, I disagree with how they allocate their capital expenditures or maintenance CapEx, which is effectively the money they need to put back into their properties so that they can produce the same amount of cash flow. And I think that's very misleading the way they represent that. But nonetheless, what's happening with this COVID-19, obviously REITs, and some are under pressure anyway because of the retail aspect to them and the office tower aspect to them, specifically in Calgary, Edmonton, have been getting hit. And some of the prefs look like they're okay value, but a word of caution, and certainly we eat our own cooking here, but we had very little exposure to the pref market, some very specific exposure, but overall very little. And we had zero, as you said, Scott, zero exposure to REITs due to a fundamental overvaluation situation as we saw it. And that will likely continue, although there may be a couple REITs, but I think you want to pick and choose what they are. I wouldn't be in them broadly in some sort of ETF or a mutual fund or anything, not a chance.
Excellent, thank you. So let's talk a little bit about our models and portfolios, keeping in mind that everyone's portfolio is very much tailored to their own specific situations. But let's look at one client's model here that's a pretty standard 60-40 style portfolio, 60% equity, 40% fixed income. Of course, we're still underweight our equity allocations, but we did add some global equity, more U.S. equity in the sell-off, so back in March, and then very recently we started to take some profits in that. So our cash equivalent down in the bottom right has actually gone up in this portfolio. At the end of March, it was closer to 22. Now it's up to about 26.5. Another thing to note in this is that the actual portfolio cash yield has come down. One of the reasons for that is that the cash equivalent with lower interest rates is paying significantly less than it was at the beginning of the year. So we're keeping an eye on that too, but it is impacting the total cash portfolio yield, which has come down slightly below 3%. And that, again, is before any capital growth. Paul, anything to add about the fixed income model or the tactical model?
Yep. Fixed income, we did lighten up on some government bonds, some U.S. 30-year bonds through late March, early April. Otherwise, we didn't really do a lot of additions. We did add some small prefs, but it's probably more at the bottom in March. Just specifically in some of our, I'll just go through each of them and just say how they've done. I mean, government bonds have continued to perform quite well, even through April, although they're not advancing in price a whole bunch more right now. But again, they have a purpose in our portfolio. They may not yield much, but over time, they've provided excellent returns. Investment grade bonds have done a fair bit better in Canada on the back of the U.S. Central Bank, the Federal Reserve, announcing on March 23rd, I believe it was, that they were buying investment grade bonds through various ETFs that exist in the U.S. The Bank of Canada said they were doing the same, buying between 5 to 10 billion, and that was just announced in April. High yield bonds that we own in the fixed income model obviously sold off in price in March and have spent much of April recovering the losses. Some, in fact, certainly one as of today, because the company reported yesterday was up. And as we talked about preferred shares already, they have done a fair bit better on the month of April. In the tactical model, through April, we didn't do a lot of individual stock purchasing there. We did some certainly in in March. As we mentioned, we bought some bank stocks, we bought some utility stocks, some telecom stocks. But one thing we did buy, which is highlighted in the red circle, is some gold and silver. And we bought a small, roughly a 1% weight, as you can see, in Central Fund, which is now owned by Sprott Asset Management. But Central Fund is an interesting way to play gold and silver because it is physical bullion, gold and silver bullion. It's 68% gold and 32% silver bullion held at the Royal Canadian Mint. So many other vehicles to get long gold and silver are through ETFs. This is actually a trust through ETFs. Like GLD is a huge U.S. ETF for gold for gold. It's really a derivative because you don't own physical gold or silver. You just own futures, and those could be borrowed, every which way till Sunday. So it could be a tricky way. Whereas what we own, we can actually take physical delivery of our gold and silver. So there's no derivative aspect to it. It's always long gold and silver. And part of the reason why we're doing this, and arguably we're a little bit late to the gold story. Maybe it would have been hindsight's 2020. It would have been nice if we bought it 6 months or a year ago. But we also think we're a little bit early. That we don't think inflation is going to rear its ugly head with so much demand destruction in the economy because of COVID-19. However, at some point, with money supply rising, which I think, Scott, you're probably going to show a chart on money supply and gold. At some point here, gold could take off like a rocket. And more importantly, silver. Silver is extremely volatile. And I'm actually happy with that because, it's trading at roughly $15 an ounce right now. It could go up to 50. It's been there before. It's got a ton of torque in it. So that's, again, part of the reason why we bought this specific trust.
And you think you may add to it in time as we sort of see how it trades and how it responds to some of the things we'll talk about in a minute.
Yeah, we have certainly we can add more to our position at that level. Yeah.
Okay, and this particular portfolio, this is how it's performed since the beginning of the year. Again, not everybody's portfolio is exactly the same as this one, but this is one client's portfolio, and it's pretty representative of a slightly more aggressive than balanced portfolio. But you can see that the downside, of course, the bad month was March, but we've recouped a fair bit through the month of April, and on the year after fees, down 3.5% so far. So we'd like to think that even though this is supposed to be a more growth-oriented portfolio, that we've been able to mitigate the downside fairly well. But let's also look at a portfolio that is intended to be somewhat more conservative. And you can just look down at the bottom of the fixed income. You can see that's close to 60%, which is its full target weight in bonds and fixed income. And then as you go to the global equity side, you can see that we're literally right at the other side. We're as light as we possibly can be. So this has been the intention of this particular client portfolio, to be on the more conservative side. And you can see the cash weighting is about 28% down over in the lower right. But this is how that portfolio has performed. So on the year, it's basically back to being flat. And March, its worst month, obviously, was down somewhat around 4%. The key is that we want clients to understand that there are broader perspectives, and we want, if clients are feeling like some of the volatility that they witnessed in March was too much for them, that we can tailor the portfolio to a more conservative approach, and that it's a conversation that we're happy to have. And for that matter, if you have family members or friends who have been suffering and complaining and worrying about their portfolios, please let them know that we're here to have those kind of conversations with them as well, because we think that we've been able to do a great job mitigating the downside to everybody's portfolios. And we've actually been poking around when prices got to their bottoms and picking up good value. And then now that we're back up to where we are, we're unwinding a little bit of that good value. And so we think we're definitely showing some benefits to our style here, and are happy at any time to talk to anybody with regards to that. Paul?
Yeah, I guess the table we're looking at now isn't my parents' account, but they're in much the same situation, and 88 and 87 years old. So for our younger clients, if they have parents they're a bit concerned about, this could take, I mean, the market's rallied back about 60% of the entire move in the S&P 500. But we really don't know where it's going to go from here. I don't think anyone does. But for folks in that age group, it could be a really tough situation. I don't think any of us want to have our parents in a situation like that where the market gets pasted, goes down dramatically, and stays down for an extended period of time. So I would encourage some in the 30, 40, 50-year bucket to look at their parents' accounts, and we're happy to have a discussion about how we manage and create portfolios for elderly folks. And just to add, we have our three models: fixed income, global equity, and tactical, but we have probably 11 or 12 models of those models. So we can create a new model for anybody, and we designed it that way specifically.
Yeah, we want to be able to tailor a portfolio very specifically to the client's needs and goals. So, and of course, we do always take a longer term perspective, but you know, as I said, if volatility upsets you, it is heartening to know that in the short term we're looking after portfolios that way as well. Well, what's keeping us up at night? We think probably that financial markets have not necessarily made it all the way through. I think the coronavirus pandemic is not something that's going away in a hurry. And it's definitely something that we keep a very close eye on. We are somewhat hopeful that we're sort of looking at the near-term peak. There's a few countries still having some issues, but generally, I think we've probably hit the peak. But there are repercussions, and certainly we're going to see the unemployment data in both the U.S. and Canada on Friday. But certainly what we're seeing and what we've seen so far is some expectations that unemployment rates are going to hit somewhere near 15 or 16%. That is as big a number as we've seen since the 1930s. So there is some repercussions here, and we do have to keep those definitely at the forefront of what we're doing. Returning to normal, Paul, we had a conversation about this slide a bit, but you know, even with economies starting to restart, this poll by Angus Reid shows that pretty much 2/3 of Canadians are still not going to be comfortable until they actually see a couple of weeks of zero growth in COVID cases. So, and then there's a portion just under 20% that aren't going to be comfortable until there's actually a vaccine. I think that is telling as to how we're going to get back, or how quickly we're going to get back to normal, because I don't think we're expecting a vaccine, at least in the most hopeful case, probably within a year.
Yeah, widely distributed at that.
Yeah.
Yeah, and you know, you can kind of forget about, I think, large sporting events, concerts, etc., until there is a vaccine. But
or
you know, perhaps businesses will open up, small businesses, storefronts, clothes shopping, etc., and regulate the number of customers that are allowed into the store on a certain footprint size. But you know, it's going to be so. I think it's going to be kind of de minimis. And even China, Scott. I mean, I think we've probably read a little bit about how China's more than a month ahead of us, and they've opened up, but it's nowhere near where anyone thought it was going to be. So this is a risk for the economy and therefore the markets, given the complete dislocation we now have again between the economy and the stock market, exactly what we had in mid-February.
Yeah. And of course, analysts are still trying to figure out what's happening with earnings. A lot of companies are just not offering up guidance anymore, but they do have to continue to try to manage expectations, but they continue to ratchet down their estimations. So that in and of itself is putting the price earnings ratio at highs that we haven't seen since back in the late 1990s and early 2000s. So, once again, we're looking at forward price earnings ratios with the denominator being earnings, and of course earnings being lowered, expectations being lowered. That puts price earnings ratios at higher highs than what we saw in February. And obviously we're finding that that's not a good representation of value. And one of the reasons why we're lightening up a little bit on U.S. equities, or have been lightening up on U.S. equities that we purchased back in March. We think we'll get another opportunity to get some cheaper ones. And Paul, you wanted to talk a little bit about this slide.
Yeah, it says the Warren Buffett indicator, but it's one of his favorite metrics for looking at valuation in the overall stock market. So this is the Wilshire 5,000 different stocks, and it's the total market cap, and market cap is basically the number of shares outstanding times the price of that stock, and over 5,000 companies, divided by the U.S. GDP. And as you can see, it's never been this high. After a very brief sell-off, it's right back to where it was. So it's an extremely, in our opinion, this is just one metric to look at, and the previous slide, I think they're two good slides to look at, but just, again, it shows the difference between the economy and the stock market. And we should say, the economy is not the stock market, and the stock market is not the economy. And that's what we saw in late February and in all the way through March, when things are so stretched and are not based on fundamentals. They tend to sell off violently.
Sure, and the real issue is how much stimulus has been put in, and the fact that interest rates are so low. Investors really don't have many places to turn, and tend to gravitate towards the stock markets because there's a lot of optimists out there that are looking beyond the pandemic and saying, well, this is a great opportunity. But to buy into this opportunity poses a huge amount of risk from a valuation perspective.
Yeah, absolutely.
You mentioned gold earlier, and we talk about all the stimulus that's been put in. But if you look over in the sort of the top right of this chart, you can see that the M2 money supply, which has just always been a gradual, or certainly for the last few years, has been just a gradual up move from the lower left to the upper right, has spiked. And coincidentally, gold has also spiked with it. Historically, as the money supply grows, or as it accelerates its growth, that has been inflationary. Now, we're not going to get inflation immediately, but you did mention that there is the potential, as we enter into recovery mode, that there will be some money supply driven inflation. And I think gold is picking up on that a little bit right now, and I guess it's a good reason why we're starting to get ourselves involved in that gold silver bullion trade.
Yeah, it's really the way to look at our gold silver position. It's insurance, and if hopefully it goes up, but if it goes up for the right reasons, we may have other problems in the economy.
Right. Okay, well, that's what scares us, but here's what we look forward to, and that it's opportunity. We know that at some point in time, or we believe at some point in time, we'll get another good buying opportunity. We don't think that the optimists who believe that this is a V type of recovery are correct. We think it's going to be more like a W type of recovery. And we believe there'll be more opportunity presented to us. And so we're happy about that. We are cautiously optimistic over the long term, but at this point, we don't expect to see things bounce back in a hurry. It's not like restarting the economy is going to click a switch that all of a sudden gets everybody back to normal. I think it's going to take us a long time to get back to that, what we'll call the new normal. Anyway, we are reminded on a daily basis by our friend David Rosenberg that some of the best stock market rallies happen in the midst of a bear market. And that brings us to the topic of our hopeful 5th anniversary event that we did push to September. We're hopeful that that will continue. And of course, David Rosenberg will be there. So if you have not received an evite in the email, check your junk mail. But if you want to be there, please let us know and we'll resend an invitation. And of course, as you all know, we continue to closely monitor all of the daily updates in light of current events, and are always standing by to discuss them with you and make portfolio changes if you wish to adjust your allocations, be less aggressive, or even if you want to be more aggressive. But if you need to talk to us directly, we are standing by. And as we mentioned earlier, we're happy to talk to other members of your family or even friends if they're interested in a conversation. Certainly, there's lots of uncertainty out there, and if somebody wants to get a second opinion, we're wide open to having those discussions. We like what we've been able to accomplish so far in light of all of this, so we're happy with where we're at. But on behalf of Bianca and Paul, we want to wish you all the best of health and safety through these difficult times, and certainly special shout out to those of you who are out on the front lines. Certainly a big thank you. We will be back with the next edition of our monthly video at the beginning of June, and hopefully we will be beginning by then to get a little closer to the new normal. So until then, please take care of yourselves.